topic. This is about an hour, 10 minutes.
Again, I want to thank the panelists because that was very, very helpful discussion. I can just tell from the 10-minute break that that to be the case. The next item on our agenda is an update from our two subcommittees. As we had mentioned at our last meeting, we believe that it's important to provide the public with as much transparency about what these subcommittees are doing, their goals, priorities, deliberations. As a result, we'll have reports from these subcommittees as a standing item on our committee agendas. As I mentioned, if the two committees, I know you've only met a couple times, but if the two committees actually appoint committee chairs amongst yourselves, then you all. So I know you all are thinking about in your busy schedules who wants to be a committee chair, but then you get to report. But in the meantime, but that would be helpful. But in the meantime, we're asking staff to report. The first subcommittee is the Cross-Market Linkages Subcommittee, which focuses on topics related to the futures markets. This subcommittee addresses topics including the analysis of orders and trading in the broad-based E-mini 500 contract, liquidity, and the selling pressure that we've seen in May 6, trading practice and rules that can affect both futures and equities markets, and some of the cross-market mechanisms and arbitrage. That subcommittee is Brooksley Born, Jack Brennan, David Reuter, Joe Stiglitz. You know, Brooksley's not here. We can make her chair, but you think
David wasn't here either at first.
I see by a vote of 3 and 1 abstention. No. All right, you all can. Jim Moser from the CFTC will provide an update on this subcommittee, let me just, I'm going to introduce the second one too, and then Jim, I'll hand it over to you. But the second subcommittee is Pre-Trade Risk Management Subcommittee, and focuses on topics related to equities, ETFs, and equity index options, though I would note pre-trade risk management also happens in the futures markets. I know you're talking about that too. The subcommittee will provide an analysis of the liquidity and selling pressures on May 6th, provide in-depth look at the order and trading of select dislocated securities, and the trade practices and rules around that, implications May 6th. Additionally, the subcommittee will provide a review of the latency issues. That's how long things get to the consolidated tape. Members of the pre-trade group, or the other 4 members, Rob Engel, Rick Ketchum, Maureen, and Susan. I guess I know who the 3 of you are appointing as chair. But no, that's not fair to Susan.
She'll be great.
She'll be great. I thought I had that Robert, but Greg's going to do it.
Susan, I'm on.
All right, Susan is, all right, protecting.
She'd still be great.
Susan, I apologize because we should have allowed you time to ask questions, and I didn't give you that chance on the earlier panels. So, but I see that you're speaking up to make sure that you're represented not to be chair.
Right.
But Greg Berman is going to work and report for us for the SEC. So, Jim and Greg, take it away.
Good morning, Chair Shapiro and Gensler and the advisory group. I'll be summarizing the cross-market presentation that were given by staff at the 2 conference calls that were held since the last public meeting. Firstly, on the 6th of July call, there were 2 presentations made. First was an analysis of the E-mini S&P 500 futures, the E-mini trading volume, and then there was an analysis of the E-mini order book. On the analysis of the E-mini trading volume and price, we found that trading activity exceeded 50,000 contracts per minute at 2 points on May 6th, at the point when prices declined precipitously, and then about an hour later or 10 minutes before the close. Trading activity was classified into 2 groups. The first group paired aggressive selling to passive buying. The second group paired aggressive buying to passive selling. Comparing these to price changes, we found no clear pattern emerging. However, at the price trough, passive buy volume much exceeded aggressive buy volume. In a plot of differences between aggressive buy and sell activity, aggressive selling turned out to be more prevalent than aggressive buying, with that difference increasing throughout the afternoon and then reaching a minimum at the time of the sharp price decline. A rebound in the aggressive buy-sell difference also coincided with the price rebound. As for the analysis of the E-mini order book, using CME supplied Globex message data, staff reconstructed the limit order book for the E-mini futures contract on the 6th of May, plotting the near inside order book depth. This would be the best 5 bids and best 5 offers. The order book appears to have been well balanced, with a number of buy orders generally close to the number of sell orders. At about 2:30 Eastern Time, there was a sharp drop-off on both sides of the near inside order book, with the drop-off in orders to buy slightly leading, then matching orders to sell. Just prior to about 3 p.m., orders to sell spiked, followed by a recovery period as the order book filled in, approaching its previous levels. Didn't quite get there, but approaching those. These data closely matched the Globex data that was provided by the CME and plotted in the May 16th preliminary report. So we felt that we had closely replicated the process that the CME was using. Staff then used the reconstructed Globex order book to construct an analysis of all standing bids and offers. The pattern from that analysis differs in that the depth of the order book can be seen to have been declining throughout the day. Staff noticed stale sell orders can be expected to accumulate over a period of declining prices. So we're not entirely comfortable with analyzing that portion of the order book, but we can say that the buy side of the order book was declining throughout the day. Staff has recently obtained order book data for some other days, as was recommended by the advisory group. These are being used to compare the May 6th order book analysis to that of other days, both critical days and so-called normal days. If I may go on. Okay. On the 29th of July, we had a second call. One presentation was made in that case, trader classification and trader behavior in the June 2010 E-mini futures contract. In this case, the data were grouped into a pre-event period that would be May 3rd, 4th, and 5th, and then an event data group on May 6th. Trading activity patterns observed during the pre-event period are analyzed in order to classify accounts as one of the following: market makers, high-frequency traders, buy, seller, opportunistic trader, and noise trader. Comparing the pre-event period to May 6 on the basis of both percentage of volume and percentage of trades, activity levels were similar for those of the assigned categories. The largest differences are for the seller and the opportunistic seller categories. Seller activity as a percentage of trades increased from 10.10% in the pre-event period, decreased from 10.10% in the pre-event period to 6.95% in the event period. Opportunistic trader activity increased from 33.34% in the pre-event period to 40.13% in the event period. We also noted that the noise trader activity, albeit small in both periods, did drop by half and went from 2.2% of trades in the pre-event period to 1.04% during the event period. The next step of this analysis will apply the relationship of trader categories to volatility normalized price changes determined in the pre-event period and apply those into the event period. This will obtain some estimates of predicted price impacts from changes in the trading activity of any single group. That's all I have. But let me wind this up by thanking the advisory group for their insights and guidances. It's been an interesting summer. It reminds me of when I was a university professor and we used to do all of our research in the summer. So it's been fun.
Yeah. And I think that the actual, if I recall, I mean, though they may not be yet on our website for the public, I think these documents, whatever Jim just went through, will be on our website related to this committee. But questions from the full committee, either to Jim or to other members of the committee who are on the subcommittee? And I just want to make sure, because Last time I didn't. Susan, did you have any questions on this one?
No, I'm fine. Thank you very much.
Greg?
Thank you, Chairman. Since the latest full meeting of the Joint Advisory Committee on June 22nd, we've held 2 conference calls with members of the Pre-Trade Risk Management Subcommittee. As you know, our investigation into the events of May 6th is based on a 2-pronged approach, combining objective data analysis with direct insights from market participants concerning their actions and decisions on the afternoon of May 6th. In our first subcommittee call, held on July 7th, we discussed preliminary observations of our interviews to date with market participants. At that time, we had already held a series of extensive interviews with market makers in equities and exchange-traded funds, from which an emerging theme had developed. We reported that most of the firms we interviewed significantly curtailed or completely halted their market-making activities during and immediately after the rapid downturn in prices at or around 2:40 of the afternoon of May 6th. Many market-making firms use a combination of automated algorithms and human traders to oversee their operations. As such, data integrity was cited by the firms as their #1 concern. To protect against trading on erroneous data, every market maker implements automated stops that trigger when any questionable data is received. One way of identifying potential bad data is to look for large, rapid price moves, which were unfortunately in significant abundance on May 6th. For example, the rapid decline in prices of the E-mini contract at around 240 triggered data integrity pauses in trading across a number of automated market-making algorithms, even though these price declines were, of course, accurate. Rapid declines in individual securities also contributed to data integrity concerns and triggered likewise pauses. Some market makers also reported that trading volume overwhelmed their internal systems, causing latencies in their ability to monitor the markets and confirm orders. Others found delays in the market feeds themselves and questioned their own ability to track prices accurately and in real time. Many were concerned that trades were going to be broken and that they would be inadvertently left long or short one side of the market. It is fair to say that most market participants felt a certain sense of real-time confusion as to what was actually occurring as many securities began to dislocate. We further noted that since exchange-traded funds are based on baskets of securities, any data issues, whether real or perceived, with the pricing of an individual security can trigger data integrity pauses in the trading of ETFs that hold those securities, and hence there is a knock-on effect. This is one of the reasons ETFs may have been disproportionately affected on May 6th. The automated trading system paused some market, as automated trading systems paused, some market makers withdrew completely from the markets and relied on auto-generated stub quotes to fulfill their market maker obligations. Others fell back to manual trading but had to limit their focus to only a subset of securities and were not able to keep up with the unprecedented volumes that were ever more concentrated as yet other market makers continued to withdraw. Through our interview process, we were actually able to trace back a significant number of trades that were executed at stub quotes and were subsequently deemed erroneous and broken by the exchanges later that evening. Our interviews with market makers were only a first step in a planned series of extensive interviews and conversations with a wide variety of market participants. At this time, we are pleased to report that in addition to equity and ETF market makers, we have now completed many dozens of detailed interviews with option market makers, internalizers, dark pools, high-frequency traders, and cross-market arbitrageurs. The noted behavior of almost all market participants remains consistent with the general theme of a rapid withdrawal of liquidity, but the specifics for each participant differ materially based on the type of participant. A detailed summary of these findings will be presented in our upcoming September report. In our second subcommittee call, held on July 29th, we covered 3 individual but related topics. These topics were chosen because they are both complicated and subtle in nature, have lots of technicalities that afforded lots of questions, and not necessarily because we believe that they necessarily presented any problems on May 6th. A number of those topics were actually discussed today, and as demonstrated, there are lots of opinions on these different topics. We began with our Division of Investment Management giving a detailed presentation about the ETF market itself. Exchange-traded funds are a specific type of exchange-traded product registered under the Investment Company Act of 1940. Today, ETFs represent about $700 billion in assets. Like mutual funds, ETFs hold a portfolio of securities and are often designed to track a given index or sector. However, unlike mutual funds, ETFs are not individually redeemable at a net asset value, but instead are traded in the secondary market alongside of individual equities. Only authorized participants can directly engage in transactions with the ETF to create or redeem large blocks of ETFs known as creation units. These transactions are executed at the end of the trading day through an exchange of creation units for a predefined basket of securities or their cash equivalents. In this fashion, the prices of ETFs and the prices of the securities that underlie the ETFs are linked through a detailed arbitrage relationship. Understanding how these relationships function provides the context to and some color on the behavior of ETF market participants on May 6th. We then turn to a presentation given by the New York Stock Exchange on the use of liquidity replenishment points, or LRPs. LRPs are essentially represent price bands within which an individual security can trade in an automated fashion. When the best bid for an individual security moves above the upper LRP limit, or when the best offer moves below the lower LRP limit, fully automated executions on that side of the book are suspended, and quotes on that side are marked as slow under Rule 611 of Regulation NMS. During an LRP, NICE continues to accept orders, and most LRPs are automatically resolved as additional buy or sell orders are received within the price bands. However, if an LRP does not self-resolve in a short period of time, it is converted to a floor auction and the security can be repriced outside of the band. When an LRP is in effect at NICE, other exchanges are allowed to trade through any quotes NICE marks as slow, though NICE cannot trade through the protected quotes at other exchanges. Also noted was that trading participants may cancel resting orders at any time during the LRP and reroute without any manual intervention. The presentation by NICE closed with a variety of statistics related to LRPs throughout the last year. In our September report, we will be providing more details on LRPs in the context of liquidity and market participant behavior related to the events of May 6th. We then concluded the July 29th subcommittee meeting with a presentation by our Division of Trading and Markets on what is known as the self-help exception to Rule 611 of Regulation NMS, something also discussed by the panelists. This rule generally requires trading centers to implement reasonable policies and procedures to prevent trade-throughs of protected quotations at other markets. Self-help permits a trading center to bypass the protected quotations of another market that is experiencing system problems. It was noted that the declarations of self-help by one market center against another are not uncommon as system issues arise from time to time. As with LRPs, our September report will provide more details on self-help in the context of liquidity and market participant behavior related to the events of May 6th. Thank you.
Thank you, Craig. Questions? Jack?
Just I don't want to ask you to play psychologist, but what was it that the market makers told you that prompted them to fear broken trades as much as the clearly erroneous trade rule? Why on May 6th? And there's lots of times where the market's volatile, and you could have that same sense. Was there some confluence of events that caused it? Because we hear it a lot in various aspects of this investigation.
Sure. Well, there's not necessarily a rule, but a bit of an unwritten convention regarding rapid price moves of more than 10%. And the exchanges can declare trades that fall within over 10% very quickly as erroneous. So when you have, this was not a matter of uncertainty in whether the trades were going to be declared erroneous. Even if there was complete certainty and the market makers knew ahead of time what would be declared erroneous, as soon as you get into an area where something can be declared erroneous, a market maker does not want to be caught with half a buck. So they will choose to not participate in the market at all than risk having one side of the trade be broken.
Yeah. Can you explain a little bit, if at the end of the day a market were still closed, or maybe this hasn't happened, if it were closed, how do the ETFs get priced? Is there a clear rule about okay, but
I think I understand the question. During the day, ETFs are priced like any stock. It's technical. It depends on the buy and sell pressure of that stock and of the ETF and the negotiated prices. There is a separate mechanism by which creation and redemptions occur. And that's where an ETF looks more like a mutual fund, where that is tied to the NAV of underlying securities. What happens is at the beginning of each day, I believe, a basket of securities is identified as the one that, as what will be tradable for creation units, or would be redeemable if you're going to redeem some shares. Again, individual investors don't do this. This is only authorized participants in very large blocks. So even if the markets are closed, the securities can still be exchanged and redeemed. There are circumstances where you have ETFs on international markets where the end of the days don't coincide, and in that case, I believe that there are lags between the time that the actual settlement happens and then the transfer occurs.
Joe, did that answer your question?
Yeah, I was going to say, I believe, I don't know how you would take the closing price of an individual stock that was closed, but I assume it's still going to be a last trade. And I would think with the ETF, you would also record the end of the day price as being the last trade. I'm not sure whether there's any provision that would be different from that if there was a you're talking about if there's a circuit breaker at the end of the day.
That was the question, but I mean, it's not like delivering wheat where you actually deliver the wheat. I mean, I assume that there is a cash settlement of some kind. Maybe John
I don't think there's any special end of day role that the ETF price plays, unlike a mutual fund.
Sure. Well, you actually can deliver the securities. So the securities go back and forth. This would only affect the case where, in lieu of transferring securities, you wanted to transfer the cash equivalent of those securities, in which case you would need to have accurate pricing for the underlying securities.
That was really the question, and I guess maybe the question is, when you actually do the settlement, do they actually...
It's one of the things that keeps them close. It eliminates the discount on a traditional closed-end fund, right? So you can deliver, you can settle in cash or you can settle in securities. The preference is not to do securities because there's transaction costs, but
so when
you can do it.
Something's missing from it, what do you do? You actually do cash
that off? I mean,
we will
do
cash out. I
securities.
don't know what happens if there's I'm not sure we've been through a period with the market closed
At the end.
At the end,
But
I'm sure it happened with the Spider on October 27th, 97. But I'm not sure how many other days the stock market's been closed at the end of the day. Are there
But
others?
Jack, isn't it correct? I mean, like the wheat market, I mean, we're going through a lot of wheat convergence issues right now in Kansas City, and we had them in Chicago. But exchange-traded funds, you can literally deliver the securities, like you could deliver the wheat, at least in theory, in Kansas City, but and in practice, hopefully. But you have to be one of these authorized participants, and it only be done by large blocks. Is that because you ran a complex?
No, that's right. That's right.
So they don't have they hopefully don't have what we have, this convergence issue. But I guess they could deliver a stock even if it's not trading.
Yeah.
Is that right, Greg?
I believe so. The question about, well, what happens if you want to deliver a cash equivalent and the stock was closed is more general. I mean, how do you come up with what the end price for a stock is? So there are lots of ramifications that there's margin on the stock. So the exchanges would need to come up with an official closing price, and I assume that whatever closing price was picked would be the one that would be relevant to the transfer of ETFs.
Rick, did you have a question?
Yeah, just to follow up on the data integrity parts of your report of the minutes, which again was echoed this morning. Do you have a better feel with respect to exactly what those conclusions of data integrity were based on? Was it that they were seeing trades out of line with quotes, trades that would other been trade throughs, or were they trying to execute trades against quotes that they were continually unsuccessful for? What were they telling you, and do you conclude that there really was significant data integrity issues across the board, or whether they were spotty or what?
Most of the market participants explain that they put automatic triggers into their system to look for anything that has the potential to be erroneous data. And the first thing that they put in is any rapid price move. So while there were true data integrity issues that we are focusing on in various different platforms. And there were also internal system issues at some of the participants. It was accurate changes in prices that I believe triggered the most of these alarms. So as soon as you have a rapid change in price, even if that's real, someone has to look and see maybe that's not correct. And that then causes this huge cascade. When lots of securities have rapid changes in prices at the same time, then folks can't necessarily respond very quickly, because each one of those securities need to be looked at individually to make sure that the prices are right. And if you are collectively looking at a whole bunch of securities and finding dislocations, your assumptions are either there's something greatly wrong with the feeds themselves, because we're seeing this everywhere, which would cause you to pause, or the feeds are completely correct and there's something fundamental going on, in which case that would cause you to pause. So regardless of whether or not the prices themselves are correct, any perception of that is going to trigger these types of pauses. And we think that was the majority of the issues.
Yeah, but I just want to follow up on that. I understand why people would not want to trade with, a market volatility, but they were using the vocabulary of erroneous data. And you would have thought that there would be some mechanism of separating out these two kinds of problems. So far, what you've described is that they don't really separate the two. And one of the concerns is, in breaking the trades, again, in terms of the erroneous data, erroneous trades, it's understandable why you would want to break erroneous trades. But it seems as if there's another principle that was here, which is trades that were not erroneous, but at prices that were larger deviations from what people had thought. And again, it seems to me that those are two concepts that are, really quite different concepts that are being mixed together, and one would have thought that there are ways of distinguishing between these two.
Yes, I think the clearly erroneous trades and erroneous data, you're exactly right. Those are completely separate concepts. The clearly erroneous trades and the cancellation of trades was one process that the exchanges got together, and we fully described in the preliminary report how that process worked, and we heard lots of feedback from the panelists on how they perceived that process. Completely separate from that is trading on erroneous data, erroneous market data, or trading when you think you're placing an order and you don't necessarily get the confirm back immediately, so there might be systems issues. That's a completely separate path. Sometimes I can imagine a situation where a trade is erroneously placed because of erroneous data, and one might want to claim that, therefore, that the trade was clearly erroneous. I don't think that's really what played into the afternoon of May 6th. Those are two separate processes.
David.
Could you describe the process for choosing the 60% figure for declaring those trades, which ones should be broken or not? First of all, was it across all of the trading centers? And secondly, why 60%? Why not 55? Why not 65? Why not 35? What was the thought process?
So three questions. The process, was it across all markets? And then the thought that went to the number. But the first thing I see, Rick is shaking his head, but Greg?
Sure. I think I might defer to Rick on this particular question.
I'm glad you're answering it, Greg.
So the exchanges did get together after, and I know that they agreed on that. I don't know if I can comment on the details of the why.
You say the exchanges. What about the other markets?
I believe that clearly erroneous trades are within the domain of the exchanges. I don't know, Rick, if you have...
I can try to help, but trying to explain the process is maybe beyond me. Each of the registered exchanges trading in a security or who had trades in a security, plus FINRA, which through the TRF or whatever it stands for, facility, which represents essentially the internalized trades of the firms and some of the dark trade volume. work together to have a single decision with respect to erroneous trades. Erroneous trades are relatively predictable from the standpoint of how those decisions work, and they're set out, and the SEC worked with the exchanges for some time for that. When it involves a single erroneous trade or a machine gun-like number of errors going in the same security, there is much more flexibility and difficulty in working it when instead it stems from a market reaction that then flows like a waterfall from that in large numbers of securities. And in that situation, there's much less guidance. There was not a there were some similar situations in September and October during the credit crisis, but not quite like this. So in those circumstances, the exchanges had more flexibility and, on the other hand, less guidance of how to work in a situation where, in simplest terms, there was no clarity that there were any error trades. In fact, there weren't. What there was a massive market panic reaction that, from a market structure standpoint, resulted in trades that simply couldn't be justifiable. And in that situation, that obviously last one was an opinion, not otherwise. In that situation, the exchanges were chary about only breaking, and exchanges with FINRA, about only breaking the most extreme trades because, as has been mentioned several times here, these positions don't stand alone. They are traded out of. They are part of hedge positions, and part of a variety of combination positions. So the breaking of trades, particularly when it's not terribly predictable, always has consequences. So I think it's fair to say there's nothing specifically justifiable about 60% as a number rather than 50 or 70. It was an effort, given the unique nature of this and the absence of any evidence of a particular area or trade, to only knock out trades that would appear to be, by at least some standard, undoubtedly, for persons involved with it, not normal and not real. And for better or worse, that was the point that the exchanges landed on, was at 60%.
What did you do, put a bunch of pieces of paper in a hat and pick out one?
I wasn't there, so I won't testify how it happened.
Do you have any information about who the market participants were whose trades were broken?
We're still working on the exact details of that, and in our final report, upcoming report in September, I think we'll go into more detail. But our initial inclination was to follow the retail path, and we believe that quite a number of those trades were actually retail trades. Most of the professionals got out of the market as soon as the decline started happening. So certainly the market makers began to pull out. Your institutional asset managers would have pulled out. So many of those trades, we believe, were originally retail trades.
So, Greg, you think, I mean, it's a question probably more on the SEC, FINRA, but that the September information will show, all right, I know the May 18th said how many trades, but you're asking who was behind them. You think that they will be able to summarize that for the public?
Yes.
Great.
Just to follow up from your comments, that seems to say that the last part of the declines down to the stub quotes was almost all due to retail trades, and it was the retail traders that were really causing this dramatic decline.
Well,
let me see, causing or getting at least. The question is who is getting stuck with the bag side of that trade, and that could be because of the way they structure their offers.
Well, I take it that a group of stop-loss orders from the retail traders or market orders from retail traders, since you say that all the professionals are out of the market. So now we have the last part of the flash crash determined by retail trades rather than professionals.
I don't want to get too ahead of the final results in September, but what we are seeing is that most of the professionals had exited the market, but many of the retail investor, some of them were stop-loss orders, so they were triggered automatically. Others were market orders that folks put in right there and then as they saw the decline going down. Though it was less around they got stuck with the bad trades, they were the only ones trading at that particular time. So you went to stub quotes And again, those trades were then later canceled for those obvious reasons.
Well, then to go one more step with it, at what point from 60% up towards 40 and 30 were the professionals out and the retailers still in? You know that?
I don't think we have details at that level. What I can tell you is that there were about 20,000 broken trades, and if you plot the numbers of securities and the trades and what the lowest point was, you will find that it's a barbell. Quite a number of the trades fell 10, 11, 12%, and then a huge number fell 90% or more. The area between 20% and 90% is very, very sparsely populated. Either you went all the way down or you stayed at the 10%, 12% level. So the difference between 50%, 60%, 55%, we're literally talking handfuls of trades in those regions. So we didn't see too many stocks fall 48.3%. Either you went all the way down to a stub quote or close to it, or you went down a nominal amount and then came back.
Were they mostly low volume? I mean, small lot sizes too?
Well, that's something that I think we'll have some cross-sectional analysis on that in the final report. But I think the answer is yes, but that's not necessarily saying anything about the broken trades. Most trades are small lot sizes today.
Spread
Susan?
across the whole market?
Susan, could you repeat that?
Were the broken trades spread across all markets?
They were, and I believe in the preliminary report we have a table that illustrates for the 20,000 or so broken trades. Different markets had different percentages, obviously. The New York Stock Exchange did not have any broken trades because of their LRPs. Others had less broken trades because they have collars on their orders, so they do not accept market orders. When they accept a market order, they'll actually turn that into a limit order, and others execute the market orders directly. One thing that I'd like to note is market orders are often converted to limit orders before they get to the exchanges themselves. So there's a limit to what the exchanges can do in terms of treating a market order. If they receive a limit order for 1 penny, then it's a limit order for 1 penny. So the situation is actually a little more complicated than just sending the retail orders straight to the market centers themselves.
Earlier we were talking about a large fraction of the broken trades being ETFs. And I guess can you answer some of these same questions about the ETFs? I mean, were they a lot of retail trade in the ETF that were broken?
Yeah. So my comments were really for all broken trades, and the majority of the 60 some odd percent, et cetera, or more of the broken trades were ETFs. So yes, everything applies to the ETFs themselves.
Susan, and it was my fault that I didn't recognize you earlier, did you have either questions for this, or even if you just wanted to share, because there were 5 or 6 really important topics about market orders and limits versus, all the 6 or 7 topics we talked about earlier that you wanted to share with the other members of the committee?
No, I guess I was I remembered that it was ETFs that were predominantly the broken trade, but I also then I didn't remember about whether or not the futures market had many broken trades.
Jim can answer that.
It did not have any broken trades.
Thank you.
Any other questions here? I think we're going to stay in our seats, but I think doesn't Greg and Steve Sherrod from our side are you going to do anything or no? No? All right. So that even makes it easier for me, because then maybe it's already been done. So you can stay, but I wanted to thank Greg Berman and Jim with regard to what they've done, as we said, again, early September, the staff will deliver a follow-up report. So we'll have the May 18th, and then we'll have this follow-up report to the Joint Advisory Committee based on the research they've conducted these last 3 months. And then once the committee has received the report, this committee received the report, the next step would be to link the staff report back to the broader mandate of this Joint Advisory Committee. And to that end, we would subsequently ask this committee to prepare a document. Maybe it's a shorter document than the staff's done. Well, it'd be as long as you want it to be. But we're not saying it has to be, but be delivered to the two commissions, ideally, by early October. We know that you're all busy and everything, but, we're trying to move this along. That would address the following points. Basically, any specific recommendations that you may have regarding cross-market policies directed and related to the issues of May 6. When cross-market issues are all of the 6, 7, 8 items earlier, and Chair Shapiro had to leave, but she particularly said some of those items earlier that were identified around collared market orders and so forth. But the pilot program, all of the things that we talked about earlier, the pauses and the limits and so forth, those topics. But certainly included in that is the cross-market policy, circuit breakers across the markets. And then secondly, just general areas of further consideration for the CFTC and SEC policy based on any broader cross-market themes. And some of those cross-market themes, again, were talked about earlier today. I mean, cross-market themes about the fragmentation in the markets and so forth, which were debated this morning. And there was obviously a lot of things that were raised by some members here, priority rules and things like whatever the committee wants to advise us on, But the two main areas are the cross-market issues related to May 6th and then just broader, advice that you have. This committee doesn't go away with that report, by the way. It goes further, so you're not off the hooks yet. So that's to aid you in the process. We're happy to have staff members of the SEC and CFTC work with the Joint Advisory Committee, collect your individual thoughts on each of the points, aggregate, synthesize the information, help organize the final document. Greg Berman and Robert Cook is here from the SEC, who runs the Division of Market Oversight. Do I have the right title? Trading and Markets. We have different names over here. Maybe we need to harmonize that too. Jim Moser and Andre Karolinko, who you've met, who are from our chief economist side, but Steve Sherrod, Rick Schiltz, and others from our Division of Market Oversight are all available to help out as well. I want to turn to my fellow commissioners because they also, Mike Dunn and Jill Summers and Bart Chilton, I think each have some thoughts too.
Well, thank you very much, Mr. Chairman. And first and foremost, I really like to build upon what you were just saying and recognize the importance of this advisory committee to us to ensure that we have an orderly working marketplace. A lot falls on your shoulder, and I appreciate Mr. Chairman, you and Chairman Shapiro getting such a distinguished panel here. I've just finished reading Joe Sticklett's book, Free Fall, and I'd highly recommend it for everybody. Since we're not paying them, we can plug them. I'll plug the Stern School of Business in Northwestern as well. Has great institutions. But one thing really struck me today, and that was hearing from the panel members that we had, not the advisory committee, but the panel members, that what happened on May 6th can happen again. In fact, they expect it to happen again. And Mr. Chairman, you made an analogy of a terrible auto accident that I was involved in, which happened in a very quick time, and what happened to stock and Accentua. But there was a big difference. In my case, somebody broke a rule. Somebody went through a stop sign. We don't have a rule here that was broken that caused this. And that is what we're looking at this advisory committee, is to provide us with the rules of the road to ensure that these accidents don't happen in the future and certainly don't happen to the magnitude that they happen. I want to build on something that Chairman did when he started, and that was talking about the Frank Dodd bill. And it has mandated that we work more closely with the CFTC and the SEC working together. And the two chairs have been working. I mean, they've already started these meetings that have been mandated. Staffs are going through those. And I hope, Mr. Chairman, that we would follow up in a similar format that we have here, where we have an open public meeting where everyone is privy to the types of recommendations and things that we were mandated to take a look at, and what our staffs are going to be recommending to us. And to that extent, there are other regulatory bodies that I still feel we ought to be working with as well to ensure that we get that out there. And I'd really like to thank the staff of both the CFTC and the SEC for the work they've done for us as the commission, but also for this advisory committee, because since we're not paying you, we don't expect you to shoulder all the burden of that. And as we stay in the agriculture area, work them like a rented mule. Just get as much out of them as you can.
Wow, I don't know what to do with that last statement. But on the one thing I want to say, Commissioner Dunn is absolutely right. The SEC and CFTC are working tirelessly together, and we are on the Dodd-Frank bill going to have a number of staff roundtables. I can't remember exactly how these are called, but some of them may even start later this month. And between the SEC and CFTC, I think they've identified 4 or 5 topics that'll be open to the public. I don't think we'll have as many cameras here, but they'll go through a number of topics related to data, related, I think, to governance, related possibly to these new swap execution facilities and so forth, and jointly hear from the public on very critical issues. And the SEC commissioners and the CFTC commissioners will be allowed to go, but it's staff's going to run them, which saves Mary and me from running these things too, probably. Commissioner Summers.
Thank you, Mr. Chairman. I think just following up on all of that, and want to say how much I appreciate the panelists being here today and all of the committee members. It's extremely important for us to look at this coordination across markets, the equity markets, the security options, and the futures, and how to appropriately impose the tools that we have on all of those markets, like circuit breakers. I think that as the markets have evolved and products like ETFs and equity index futures have increased, the interconnectedness of our markets and the markets that we each regulate have also increased, yet we have completely different market structures and completely different rules on either side. So, some of the issues that we talked about today, high frequency trading, co-location, and just general market structure issues are before both of our agencies. So I think I can't really stress enough how forums like this to increase the dialogue and cooperation between the two agencies is extremely helpful to me, but I think to us all as regulators. So thank you all for being here.
Commissioner Chilton, we're bound to get a soundbite here, I know.
Thanks, Mr. Chairman, and thanks everybody's staff in particular. I know you guys you've already been working like rented mules, and thanks to the advisory committee. People are going to say, is it going to happen again, like Commissioner Dunn said, and the answer is it could. I think it's less likely that it would today with some of the changes that are being incorporated, and as we move further down the road, it'll be even less likely. But you can't give certitudes. But as we're talking about all these issues, and it was fascinating, all of the suggestions that the panel had, but people come up with these sort of phrases about what happened on May 6th. They say, well, it's a perfect storm, or it was a collection of culprits. And I think sometimes it's too easy for us to rely on that when we don't know what specifically it was. Well, it was a bunch of things. I'm not saying that it wasn't a bunch of things, but by the same token, I think that the panel and the staff should be still looking for a smoking gun. And one of the areas, and I'm not saying that this is a smoking gun, but one of the areas that was not discussed a whole lot today is this gap between the consolidated tape and the premium tape on the New York Stock Exchange. And at times there was more than a 20-second delay. And so, what I think we need to do is make sure that there wasn't any price trading, these algorithmic trades that could have gone in and simultaneously bought on the real-time feed from the New York Stock Exchange, and then sold on the delayed feed, the consolidated feed, boom, boom, right away, hundreds of times, and taken just a minute advantage individually, but collectively it could have been a larger amount. Now, when I started thinking about this, we have a technology advisory committee that Chairman O'Malley convened a couple of weeks ago, and I asked these sorts of questions then to make sure that I wasn't sort of a conspiratorial person thinking this is crazy. And 4 of the folks that are on this panel, eminent experts, said they thought I was crazy to ask. Of course that could be going on. And so I don't feel as nutty about asking the question, and maybe there's nothing to this, Greg or Jim, but that gap, 20 seconds, might not be a lot in our lifetimes, might not be a lot for a lot of folks. Basketball game could be something. In these markets, it could be huge. And so I hope we make sure that these algorithmic price pirates aren't seeking false profits, that they aren't trying to go after something they shouldn't have gone after. So thank you again for everything.
Thank you. Rick, you have any? Greg, you have any? All right. So, it's something that, Joe?
I guess 2 questions. One is, we've been talking about the U.S. market. I gather there have been similar spikes in a couple of other markets. Has your staff looked at any other markets where anomalies of this kind have occurred? And because we've been talking about different rules and the impact, it might be of some interest to see whether they've gone through a similar kind of exercise.
We're aware of the different structures that exist in different international jurisdictions and other types of markets. There is something that's very unique around the U.S. equity market in that it is fragmented. There are different market centers. There are at least 9 to 12, depending on how you count, the ones that are visible. And as we've heard from a number of panelists, people like to use the number 40 as the total number of venues that are actually out there. 40 times 40 is 1,600 different combinations. So while there are certainly things that we can learn from observing these types of patterns in other markets, a lot of this is within the U.S. that we'll have to study.
Yeah, I guess a particular question I was concerned with is, if there are these kinds of spikes occurring even without this complexity, ours may be more prone because of the complexity, but it would remind us that even without that, we have something to worry about.
Agree.
And we're also looking at, as I mentioned, the order book activity on other days. 2 of the days, as I recall, were in the third quarter of 2008, where there were sharp breaks as well. So what we want to do is analyze and see, in what ways was May 6th different than those sharp breaks, and how did the order book evolve on those days?
Let me just mention, I think Australia had a big spike. It was an upper one. And in their case, it was a wrong order. Somebody pushed the wrong button. But the reason I mention that is it shows the fragility of the system to a mistake. So that's at least one thing that one wants to worry about. And if that's the case, then obviously in a world with all the kinds of fragmentation that we have, the problems could be much worse.
We have some outstanding research from other era trades done in the United States. There aren't too many to actually analyze, but what we found is that in general, the market does come back very quickly, recognizing that it is an error, and it just bypasses it. I'd be glad to send the advisory group that paper if you like.
There's one more question I wanted to ask.
Four more.
And that has to do with what you mentioned, the Dodd-Frank bill. Are there particular regulatory issues that they raise that you think interact with what we should be doing?
Well, I can't speak for the SEC, and as you know, the CFTC largely swims in the lane of derivatives, foreign exchange derivatives, which we call futures now, but then these newly regulated over-the-counter derivatives. I do think market structure issues here are going to play a tremendous role because, as you know, Congress enacted a bill that says all standardized derivatives, that which can be cleared on a clearing platform, has to come to a clearinghouse. And there's various estimates, but it seems that would be a majority of the over-the-counter derivatives marketplace by far. And that those have to then be exposed to transparent trading venues. And these transparent trading venues can be swap execution facilities. And so from the world of the futures market, which has been, as people have pointed out, has been sort of less fragmented than the securities market, this over-the-counter derivatives marketplace may well have multiple trading platforms. In fact, there could be dozens. There be, the bill actually fosters competition amongst these trading platforms. So I think it will be helpful as you're thinking about fragmentation and market structure issues. I mean, Congress has dealt with the broad policy. There will be swap execution facilities. They're supposed to be open to multiple participants, making bids and offers to multiple participants, so it's what people call many-to-many. There is pre-trade transparency, but how they all sort of work and in combination to enhance market liquidity, enhance transparency, enhance efficiency of markets, which is what part of the goal of the statute. I think that will be helpful to get your advice. Not that you might not have advice on clearinghouses and other things, but I think that it's probably more around the trading venues that it's very similar types of issues might arise.
One in particular was raised this morning that which is the bill encourages trading on exchange and clearinghouses, but also allows for over-the-counter. And some of the issues we've been talking about, dark pools versus transparency, want to raise the concern that how you organize the transparent part can affect the magnitude of the trading that goes in the dark pools. So it seems to me that that's one of the things that...
Absolutely. I think Congress addressed part of that in that they said even on the bilateral transactions, those that are not on the trading have to be reported in a real-time basis as well. So there's post-trade transparency. We have to sort through the SEC, and we have to sort through how to do that. But in terms of what's on the swap execution facilities, Congress also addressed it by saying it's multi-party to multi-party. Some of the dark pools currently in the equity markets, the darkest of them are sort of proprietary platforms, if I understand. And it appears, at least to this reader, I can't speak for my fellow commissioners, but that the Congress sort of addressed that and said, no, it has to be multi-party to multi-party. It might be addressed right there in the statute in a sense, but those will be subject to interpretation, obviously.
I guess I'm wondering what we could do that would be useful, and perhaps maybe the question is what's actually feasible in terms of the various incentives for public liquidity display that were talked about today. Things like, treating cancellations differently from just having them freely available, changing priorities, changing access fees or rebate structures and so forth, which are to some extent under regulatory supervision and to some extent are exchange set. What's the scope that we can think about here?
Well, I would hope that you would help the two commissions on things that are, within our authority and jurisdiction. So, though you could take up, I think it was one of the earlier panelists' thoughts to, they had a recommendation about the tax situation. The SEC and the CFTC don't have those authorities. So I think what would be best is if you recommended things that are either within our authority, or if you think there needs to be a change in law, that it would a change in law related to our specific authorities. Obviously, you could.
When I used the word tax, I guess I meant charge for cancellations.
Well,
exchange charge for cancellations.
I think the wonderful thing about advisory committees, and this one's got an esteemed group, but is that we're not looking to limit you. I mean, if you have a good recommendation and there's a consensus, we want to hear that. And so, but the immediate thing is the events of May 6th, then the cross-market issues there, and then obviously some general market structure issues. And since the panel doesn't go away, I mean, we're hoping that there'd be lots of other advice along the way too, but we'd like to. So what's feasible is also what is doable in a timely way. As the first report from the advisors, the 8 of you. Susan, any?
I guess I was wondering after this September report and if there are recommendations that come out of that, relating to circuit breakers, or different types of orders, some of the market rules of trading kind of stuff. What other kinds of issues are the two commissions interested in having the committee look at?
If I could ask that, because you're really saying what might be the agenda for this advisory committee beyond this, and if that's an excellent question, but why don't you allow Chairman Shapiro and myself, working with our fellow commissioners, to kind of come back to you as we sort through this first. I think if I understood your question, but maybe I didn't. I don't know, Commissioner Dunn.
Well, it would be good to hear from the advisory group of what type of things they think they ought to look at. That would be very helpful.
So, I mean, this group was set up immediately with the May 6th event, but Chair Shapiro and I have been talking about it since the presidential transition. Then acting Chairman Dunn had sort of suggested we have this too. And we worked with Congress to actually get this authorized. Believe it or not, we had to have this committee authorized because we couldn't spend money on behalf of the SEC, and they couldn't spend money on behalf of us. You had to change an appropriations law to do a joint advisory committee. It's a great country, and so we did that with the support of many members of Congress, and so. We really do look this to be a committee that goes on to talk about emerging risks. That one of the things that came out of the crisis of 2008 is really to have an outside group of experts advising these two market regulators that bring some harmony amongst them, but beyond the harmony is to really say, well, what are the emerging issues? What are the things that is the next thing that's on the horizon? So you got sort of commissioned into service with a specific task of May 6th, but it's much broader than that. It's what do you see on the horizon, and what are the things that you think the nation's two market regulators should be, thinking about. But that's past October.
Yeah. Can I just make a comment related to the discussion we had earlier this morning, which it's very clear that there's been very big changes in the structure and the performance of these markets in very recent years, which affect both the liquidity of the markets and incentives for various market participants to gather information. One of the other previous one, you talked about the incentives of those who are doing fundamental research to their ability to extract returns for those investments. So in some ways, it seems to me that one of the questions is not only a question of stability, but also even the efficiency of these markets with respect to the issues with which the fundamental roles these markets play in making the real economy work better. And I think that should be an important focus.
Maureen?
Well, I was just going to say, to some extent, the SEC's concept release also is all about that. And so I think, to some extent, we want to make sure that we're not duplicating what they're doing, but actually moving beyond that as well. And so certainly those issues are there. And the SEC has got that out, and that's been out now for, 3 months, 4 months, something like that. So hopefully we'll be able to add to that as well.
Just could I make a comment about staffing? We don't have an identifiable staff that reports to us. I presume that the SEC staff and CFTC staff are available to us. I would hope that we would receive from the joint staffs a kind of summary of the various suggestions that have been made, so that we wouldn't be starting from scratch in September when we receive a document from you. I
think, David, that's an excellent suggestion. I think that technically speaking, now I turn to, you don't need to speak, but Jim and Tim, right, because you're from aren't you officially the committee staffs? Yeah. So Jim Burns and Tim Karpoff just got outed. But can you follow up, because I think it's excellent. So just what are the things that outside market experts or the panelists have suggested, and what's the sort of things? That's what you're really saying.
Yes, and so that we can consider those in the time frame between now, so that the report then, in terms of the kinds of suggestions we might make, and that would give us also an opportunity collectively to make other suggestions that any of us might have. And I would hope that we could have some procedure for circulating papers without having a public meeting about what we may think.
All in compliance with the Federal Advisory Committee Act.
I understand that.
Right.
And you've given us over the past some documents that have been helpful, some sets of testimonies, but I would also urge the staff to give to us, if it's available to them, any written papers and documents that may be helpful to us in making decisions and evaluating suggestions. This is, as you know, an extremely difficult subject matter and very technical, and we need all the help we can get.
Both excellent suggestions. I think with that, I'm supposed to turn to, just to make sure this is the administrative side, but we need to discuss and approve the minutes of June 22nd meeting of the committee. So I'm ask whether there's any discussion of the minutes. They're in your binder. Do I hear a motion to?
So moved.
Do I hear a second? All in favor?
Aye.
Aye. Susan? Any opposed? Looks like the ayes have it. And then I guess, what do I do next? Hopefully I can adjourn. And then I just want to really thank everybody. I want to thank my fellow commissioners, all the panelists, and the committee members. I think this has been a terrific dialogue today. And so I would ask for, is there any other committee business? And so I would guess, not hearing any other committee business, I can declare this meeting adjourned. I might have to entertain a motion. It's a FACA committee, right? I have to entertain a motion.
So moved.
Any second? All in favor?
Aye.
Aye. All right, the committee's adjourned.
Probably a minimum of legally.
Of the $787 billion economic stimulus